The traditional financial industry treats a mortgage as an isolated liability, a debt instrument to be secured at the lowest possible interest rate. For high-net-worth individuals, this siloed view ignores the broader utility of credit. Specialized credit serves as a strategic lever to keep capital deployed in higher-yielding environments. Managing this requires a specific equation. It integrates debt structure, the yield of parked assets, and the timing of retirement drawdowns. These variables require active management, adjusting to shifting market conditions, like 10-year treasury bounds, to remain effective. We are deconstructing how an advisory firm utilizes these specialized credit facilities to generate a 4% yield on idle funds that most lenders leave on the table. This level of integration requires high-velocity execution, such as closing a $2.75 million jumbo loan in a 7-day window. Effective wealth management now relies on the seamless integration of specialized credit into a client's total financial footprint. Consider a client purchasing a $1.1 million home. The objective is to secure the property while maximizing the utility of their remaining liquid capital. On this balance sheet, we see the $1.1 million asset. To maintain liquidity, the advisor deploys $600,000 toward the down payment. The remaining capital is isolated as parked assets. These funds are then managed to generate a steady 4% return. By maintaining this liquidity, the yield from parked funds offsets the interest cost of the mortgage. This preserved liquidity provides the client with a strategic buffer that impacts their long-term retirement planning. As shown on this timeline, having access to these funds allows the client to preserve their wealth for longer by delaying their Social Security withdrawals. This arrangement converts a standard home purchase into an active engine for wealth preservation. Traditional debt-to-income metrics often disqualify high-net-worth or self-employed clients whose wealth is not captured by a standard W-2. To solve this, advisors use a 60-month asset depletion calculation to qualify clients based on their total liquid holdings. This calculation divides the client's total assets into a qualifying monthly income stream that meets underwriting requirements. This provides a pathway for retirees to access competitive financing without needing a traditional salary. For self-employed business owners, non-QM bank statement loans provide a similar level of flexibility. While these loans require a 10% down payment and higher rates, they allow for approvals based on actual cash flow rather than net taxable income. Bridge loans and zero-cost HELOCs are added to the toolkit to facilitate transitions between properties. This map shows migration vectors toward New Jersey, Florida, Pennsylvania, and North Carolina. Using bridge tools, clients can secure a new home before liquidating their current one. This allows for a seamless relocation without a forced sale of the client's original assets. These specialized instruments provide a level of capital nobility that is impossible under standard underwriting guidelines. Deploying these products requires more than just technical knowledge. It requires a specific operational structure. The difficulty of this execution is clear when handling a $2.75 million jumbo loan. Closing such a loan in 7 days requires managing complex credit issues and immediate disclosure requirements in real time. Most firms fail due to communication fragmentation at the handoff points between advisors, processors, and underwriters. This firm maintains a single direct line of contact between the primary advisor and the client throughout the entire process. This zero-baton handoff rule ensures the client never experiences the friction of internal underwriting delays. This front-end simplicity is backed by a team of lawyers, accountants, and wealth advisors working in the background. This coordination allows the firm to move from reactive mortgage processing to proactive estate and tax planning for every deal. Constant communication and cross-disciplinary support are the baseline requirements for executing high-complexity deals. While technical mastery of credit is the foundation, scaling this model relies on leveraging both technology and local networks. AI-driven tools and custom GPTs are used to automate content and scale client outreach. These systems handle the repetitive tasks of education and prospecting, freeing the advisors to focus on complex deal structures. This technological efficiency is paired with high-trust environments like the Elevated Alliance Mastermind. The firm utilizes a 3 C's strategy, connecting companies, charities, and the community, to find the high-net-worth clients who actually need these specialized instruments. Leading local initiatives, such as the Breakthrough T1D Walk, built a network of professional referrals among local leaders and business owners who value high-level execution. By combining AI-driven scale with deep local involvement, the firm builds a referral network that is difficult for outside competitors to disrupt. In the financial sector, trust is often described in abstract terms, but it is a concrete business metric. Trust is the measurable result of combining accurate financial math with reliable communication. The data proves the efficacy of this model. 17% of the firm's total annual revenue is generated by referrals from past clients. Specialized credit products and community integration act as the engines that drive this recurring revenue loop. Sustained growth is the result of engineering debt into wealth and converting operational precision into long-term client loyalty.